In this video, I'm going to talk about not only do they exist, but everything you need to know about a simple interest term loan. So simple interest term loans exist. They are used for starting a business. They're used to consolidate debt. They're used for home improvements. They are used for, any opportunity that you have. So for example, a lot of people come to us when they want to start an Amazon store or a Walmart store that's fully done for you, fully automated, and they use a simple interest term loan. And they do that because you have 3 to 5 years to pay it back with low monthly payments. It's the same reason why people that are looking to start a business can't or don't want to go through the SBA process. They prefer to go and use a simple interest term loan because it's quicker, it's easier, and it's cost effective. It saves them a lot of money over the course of time when they're paying it back. The terms are usually 3 to 5 years and simple interest starting as low as 6%, and it goes up from there. The rate is determined by the applicant's credit. So the better the credit that you have, the lower the interest rate that you're going to get. Same thing, you do need to show provable income. So if you can show a steady job with at least $50,000 in provable income, that will be enough to qualify, as long as your debt to income ratio isn't crazy and out of whack. What does that mean? Well, you want to make sure that you don't have so much debt that you can't repay the loan. That would be problematic, and that would cause you to get a higher rate or just get declined. So basically, the higher your credit, the lower the rate's going to be, and the more provable income that you can show, the larger the loan size is going to be. What I mean by that is if you show that you're making $120,000 a year, you might qualify for up to $100,000, maybe even more. The bare minimum qualifications is $650 credit and $50,000 in provable income. If you have those two things, you should be able to qualify for a simple interest term loan. Now, if you don't have the right credit, you could use what's called a cosigner. A cosigner is someone that is willing to sign on the loan for you, and if they have better credit, it'll give you a better chance of getting approved, right? So if you don't have the strongest credit or you don't have 650 credit, that's one way to work around that. When you're going for a simple interest term loan, you just want to be sure that you match and you have all the qualifications. Now, what's the process? The process is pretty simple, right? You just need a one-page application. You complete that one-page application. That goes in and you submit your proof of income. Proof of income is your last 2 pay stubs or a W-2. If you are self-employed, meaning you own a business, you could show your tax returns, and if you pay yourself, I would also show your pay stubs. Some business owners don't pay themselves, they just take distributions from the company account as profit, and that would be shown on a Schedule C or their tax returns. All right, now, if you are a business owner and you want to get a simple interest term loan, it's very, very important to know that when you do apply for a term loan, you have to prove that you've been in business 2 years, at least 2 years, and that the business is profitable. So if you've been in business at least 2 years or self-employed at least 2 years, and your business is showing a profit in the most current year, you should be eligible for a simple interest term loan. Right now, one of the things I want to get into that will really help is, why is it called simple interest versus what compounding interest? Well, one of the key differences is normal interest, it compounds, right? You have a credit card, and basically what'll wind up happening is if you don't pay it off in full or you just pay the minimum, you're paying interest on top of interest, which compounds, right? And that actually makes that type of financing much more expensive. When you have simple interest, you're only paying interest on the principal. That's it. So the interest isn't compounding. So if you were to take a simple interest term loan versus a loan that has compounding interest, the simple interest term loan over the course of time, you could calculate exactly what you're going to be paying back, and it would be cheaper. It's much cheaper than credit cards, because one of the traps that everybody falls into with credit cards is they run up credit cards, and sometimes they don't have the cash flow to pay them off. When you get into that cycle of keeping those credit cards open and with high balances, that interest compounds, right? And so what that does is it makes the money that you borrowed cost more, meaning there's going to be more that you're going to have to pay back because you're not paying it down quick enough. Whereas with a simple interest term loan, when you consolidate that, you're only paying interest on that principal, and that interest isn't going to compound. And that makes a really, really big difference. It makes it much more cost effective. When you have 3 to 5 years of monthly payments, what that does is it allows you to pay it over a much longer period of time, and that means you have a lower monthly payment. That allows your new startup, whatever venture it is, it could be an Amazon store, it could be opening a pizzeria, it could be opening a gym or a daycare center. When you have a lower payment, there's less expenses that are running through the business. It allows the business to cash flow more, and ultimately if the business is cash flowing more, it's easier to grow and scale. Whereas if you were to use, let's say, a financing program that only gives you a year to pay it back, that payment's going to be much higher, and a higher payment is going to hurt the cash flow. It's not going to allow you to scale as quickly. And because, if you have a lower payment, you have more cash flow, you can invest more money back into the business in advertising or whatever else you need to do to help the business grow. Now, if you're looking to get a simple interest term loan, here's a couple steps that I would suggest before you even apply. 1, go check where your credit is. Okay. 2, look up your W-2, see exactly what you made last year, and then look up your last 2 pay stubs. All right. If you are on pace to make, $45,000, $50,000 or more, and your credit is above 650, and you don't have any recent lates or charge-offs or any real challenging credit in the last, call it 6 months, like any missed payments in the last 6 months, you should be good to qualify. What I would do is go to our website, integratedbusinessfinancing.com, and hit the tab for contact us or see more or apply now. Apply for a simple interest term loan. The great part about a simple interest term loan, it really only takes 24 to 48 hours to get pre-approved, and we can have money in your account in a couple days after that. If you have any questions about anything we went over, please feel free to reach out.